Today we're going to kick off the first part of a two-part series about year-end tax reduction strategies. Today we're going to go through the information that you need to gather, what you need to put together, so that way you can make informative decisions on tax strategies to help you reduce the long-term taxes you'll pay to the IRS. Plus, we're going to start talking about your retirement accounts and the strategies to implement before December 31st, again, to help keep more of that hard-earned money in your pocket versus giving it to the IRS.
Welcome to the Your Life, Your Money podcast with Scott Searens, teaching you how to thrive in life, wealth, and retirement.
Welcome to another episode of The Retirement Show, all about your life, your money, and your taxes. I'm your host, Scott Searens, and my goal is to help you maximize whatever you want your future retirement story to be. And today, I want to kick off with this. Let's just say I was to give you $1.5 million. I know, generous guy, just handing out money. Actually, no, but let's just say I am to give you $1.5 million. But there's a little kicker with the $1.5 million that I give you. Yes, you can spend it. It's your money. But the kicker is when you take and spend this $1.5 million, there's a 15% charge to do so. But hey, it's your money, it's yours, so why not enjoy it, spend it, use it? You just have to know that there's a 15% charge to do so. And you're like, well, hey, it's Scott gave me the money, I'm going to use it, I'm going to spend it. Let's say you spent $100,000 of that money, right? Well, you actually get to utilize $85,000 and $15,000 is going to the spending charge. Now, what if I gave you the option and I said, okay, this $1.5 million that I've given you, what if you just, I'm going to say you have to do a little bit of work. Let's call it 1 day's worth of work, right? 1 day's worth of work, nothing really, but it's a little bit of work that you're going to have to do. And if you do that work, the charge will be reduced from 15% to 10%. So, I don't know, think about that, right? 1 day's work, but now you spend $100,000 and instead of only keeping or being able to use $85,000, well, now you're able to use $90,000. So that's $5,000 more of that $1.5 million. You get $5,000 more to use out of 100, right? So instead, only $10,000 goes to the charge. I mean, that's a pretty good deal for a little bit of work, right? Like reduce the charge, you keep more money. I'm sure you can think of a lot of things to do with $5,000. Well, why do I bring this little hypothetical example up? So don't be calling me, sorry, I don't have the $1.5 million to give to you. But why do I bring this little example up? Well, the $1.5 million, that's your IRA, that's your 401k, that's your 403b, your 457, your ESOP plan. That's that kind of money. The charge, well, guess what? That's actually taxes that you're going to owe the IRS. But remember that 1 day's worth of work that I was talking about that could potentially help you lower that charge of my little example there? Well, that 1 day's worth of work, and it's not even a day's worth of work, just let's call it the work. The work is tax planning. And by tax planning, you can potentially lower that charge on the money that you're going to take out of one of those accounts. And therefore, let's just say you do a little bit of tax planning. What if you could potentially lower that charge by $100 a month? I mean, that's a free meal out, right? What if it's lowering that charge by $10,000 a year? Let's say that's another potential vacation for you. What if you can lower that charge by hundreds of thousands of dollars? Imagine what you could do with the extra money, all just from doing a little bit of work called tax planning. I'm sure you've heard this, right? There's two things that are certain in life. One is death and the other is taxes. Now, we can't control when we're going to pass away, but one of the things that we can help control, that we can try to control, is our taxes. And that's through tax planning. And so it's that time of the year. The reason why I'm bringing all this up is we're heading into the end of September here, which then leads to October, November, December. And the reason why I counted them out, because 3 months can go pretty fast. And there's a lot of strategies that have the December 31st deadline that you have to get the strategies done by. Otherwise, guess what? You've missed out on them and another year's gone by, and then you've missed out on potentially lowering that charge on your IRAs, 401ks, 403bs. So that's why I start talking about it now. I want to this episode and then the next episode. So we're going to have a two-part series here. It's going to be all about year-end tax planning and overall tax strategies to help reduce the long-term taxes that you're going to pay to the IRS. We're going to take some time. I'm going to walk you through some total financial health statements so you understand the parts that are so important to understand of what you actually have, how that then fits into a tax projection, and then we're going to use those to start talking about the strategies to potentially implement to help you lower your long-term tax burden. So hopefully that example gets you thinking, right? Because I know we can just say, oh, lower the taxes on your IRAs, 401ks, but you actually have to think about it. The money that you have already, it's not the $1.5 million I've given you, it's the $1.5 million that you've saved up, or $2 million, or $5 million, or $500,000, whatever you've saved up. How much of that you actually get to keep and use and spend in your retirement and do all those fun things that you want to do is all what you do about taxes. Now, you might already be thinking, well, wait a second, I have a tax preparer. And I'm going to tell you, there's a lot of great tax preparers out there. But there is a big difference between tax preparation and tax planning. Tax preparation is a look at history. I've got a great tax preparer too. She does a great job. But it's a look at history. It's a look at last year. If you think about it, in whatever time frame of the year you do this, right? Some people it's February, March. Some people it's April. Some people go past the April 15th deadline. But you're putting together all of your documents for things that had already happened in the past. And you're giving it to your tax preparer, and they're filling out all the forms, helping you understand, okay, here's what you owe for last year, and maybe here's a few things that you can do to reduce your taxes, but again, for last year, things that happened in the past. Where we help clients focus, and where I think you want to focus, is on tax planning, which is the future. It's saying, okay, how much is sitting in our IRAs, 401ks, 403bs? How much income do we have coming in? How much income will we have coming in our future? And based on all of these things, which I'm going to walk you through, and if you're listening to this on your favorite podcast player, I'm really going to stress to you to go to lifemoneyshow.com and watch the video, or go to YouTube and watch the video, because we're going to show you a lot of pictures today that are going to help you understand tax planning. What does that future look like? What tax brackets would you be in? Are you going to be in higher tax brackets, lower tax brackets? And then what can you do today and over the next maybe so many years to help the overall taxes, help reduce the overall taxes that you're going to pay to the IRS? So there's a big difference. Tax preparation versus tax planning. Tax planning, again, lowering the long term, not just the today taxes, but the long-term taxes that you'd pay to the IRS through different strategies. So we're going to walk through that. And the first thing in tax planning, so we're going to go tax planning, like I said, understanding what you have. That leads to putting together a tax projection. And then we're going to start hitting up on those year-end tax planning strategies to help you reduce your taxes. Yes, maybe even today, but also over the long term of what you'll pay to the IRS. And so first part that is important to understand is just, what do you have? What do you have from an income standpoint? Where is the money that you save? So let me just walk you through some things. And as I do, I'm going to talk about them. I'm going to help you understand how these items impact your future taxes. So let's start with our total financial health statement here for cash flow, savings, and goals. And again, hypothetical example, just to help you understand how all of these different parts and pieces impact your situation. So take your stuff, take your actual items, your actual income, your actual savings, and plug them into here. And you'll have to create your own scenario, but at least you'll see how it plays out here. So Steve and Sue sample, they're both 62. They're going to retire at 65. And here's the thing, whether you're a single or a couple, you'll be able to plug your information in and see and understand how it's going to impact you from a tax standpoint. The other thing is whether you're already retired or whether you're still working. Watching this is going to help you reduce your long-term taxes that you're going to pay to the IRS. Okay, so they're still working. You might be retired, but hey, again, we'll get there. You'll see how everything's impacted. They plan to retire at age 65. Now, why is that a big deal? Well, as we put together the projection, they're going to have their employment income come in through age 65, but then it's going to stop. Employment income, their salary, is taxable income. All adds into taxes. Now, then it stops. So you might already be thinking, well, yeah, their income stops. They're going to be in a lower tax bracket in their retirement because they no longer have their salaries coming in for work. Not necessarily. And I'm going to show you why as we go into further detail here. Now, we also have in here kind of what their expenses are, how much they need to live their lifestyle, and then what they want to do for activities and travel. Maybe like, okay, is that important? Yeah, sure is, because that's going to, understanding that helps you understand how much you're going to need to pull out of your retirement savings to make those items happen. And understanding how much you're going to pull out of your retirement savings, you're going to see also leads into you potentially paying taxes. Okay, so $7,000 a month lifestyle, $15,000 a year for activities and travel. Now that's through age 80. Social Security. I'm just trying to keep this simple today, right? They have the same Social Security amounts at their full retirement age. They're not taking it yet. Steve's $3,000 a month, Sue $3,000 a month as well, again, at their full retirement age. Now, current income sources. Again, just trying to keep it simple. Both Steve and Sue here making $100,000 a year. You'll see how this plays out, but so they have $200,000 of gross income coming in. Steve plans to take his Social Security at age 70. Now, why is that important? Well, depending on when Steve takes his Social Security, it's potentially part or up to, potentially none, or up to 50 or up to 85% of your Social Security can add into your taxable income. So Social Security is not only a decision based on how much income do you need to live your lifestyle, but Social Security is also a tax decision as well. Sometimes taking Social Security early is actually taking away from other tax strategies that you could potentially do. Sue plans to take Social Security at age 65. So all that's going to factor into the tax projection we're going to show you here in a little bit. Now, continuing to run down our total financial health statement. If you're, again, just listening to this, hopefully you're catching on to some different things that I'm saying. Steve and Sue are both putting into their 401k accounts at about 25%. So what would that be? $25,000 a year. And the company match 100% up to 6%. They're going to do that until they retire. That's important to know because the 401k is one type of account. Now, when they're putting into their 401k, they're doing what? Getting a tax deduction today and then kicking the tax can down the road. They're going to say, hey, I will pay tax on this money later. Now, the other thing we want to continue to get to know about Steve and Sue is where does their money sit today? You know, I find this is kind of a big difference too in kind of tax preparation versus tax planning. A tax preparer doesn't have access necessarily to everything that you have in your life, right? How much you've got saved in brokerage accounts and 401ks and tax-free accounts. And so you have to understand this is a huge deal regarding your future. So sometimes when someone might make a suggestion on how to lower your taxes today, you have to understand, are we really taking a look at that full picture? And as I show you all this, I'll show you how what Steve and Sue are doing today is actually incorrect for their futures. Maybe putting into their 401k today, getting that tax deduction today could actually be hurting their future. And I'll show you that here in a minute. All right. So now moving into their net worth statement, their total financial health here, just taking a look at all the different accounts that Steve and Sue have. And pretty simple. They've got $100,000 in a taxable account. Now, this is a brokerage account, but what would fit in the taxable column? That would be checking, savings, CDs, brokerage accounts, trust accounts. Why does it say taxable? Well, you've already been taxed on that money. So wait, why taxable? Well, you get taxed on the interest, dividends, and gains each and every year. It's really important to know and understand that. The tax deferred bucket here. So let's see, Steve and Sue in their tax deferred bucket, they have, between the two of them, they have $750,000 each, or $1.5 million total. Now that's super important to understand, especially for what we're talking about, year-end tax strategies, as well as their long-term taxes that they're going to pay to the IRS. Why? Similar to me in my example of giving you $1.5 million, Steve and Sue have $1.5 million that they haven't paid a dime of tax on yet. So they're going to have to pay a charge called taxes every time that they take money out of that account. You already know this. I understand that. But what they do about their taxes will help them potentially reduce the charge on the money that they take out. And what they do could either help them keep more of that $1.5 million with them to be able to spend on things that they love and enjoy versus giving it to the IRS in taxes. Now, not really coming into play here, but they have got $650,000 residence. This does come into play when it comes to taxes. They do not have a mortgage, so no mortgage interest to deduct. So there you go. Before you can even get into tax strategies, which is the right thing to do by the end of the year, or what should you be implementing and changing and doing to lower your long-term tax brackets, the first thing you have to understand is actually what you have. What sources of income do you have coming in that will get taxed? What sources of future income will you have? Meaning, where have you saved your money? Is it in a taxable account? How does that get taxed? Is it a tax-deferred account? In the tax-deferred account, you're going to pay ordinary income tax on all of that money. Or is it in the tax-free bucket, the Roth IRA, the Roth 401k? We have to understand not only what you have coming in and will have coming in, but also where you're going to go to grab money to make sure you can maintain, live your lifestyle, and do all the fun things that you want to do in your future. Step one. Step two, see, we haven't even gotten to tax strategies yet. Step two is understanding what does that mean for you and where you're at today in your future from how much taxable income that you'll have coming in. All right, taking a look at this. Now, for those of you listening, this is a tax projection. And as you can see here for Steve and Sue, and I'm just kind of highlighting some different things. Right now, they've got their salary coming in. That's the blue on the screen. And yep, once they retire, that goes away. That's where a lot of people think, oh, well, if I don't have a salary, then my taxes will be lower in retirement. Well, maybe, but maybe not. And if you've done any sort of savings and into an IRA, 401k, 403b, or 457, maybe most likely not. Because you can see here, the blue is their salary and other income, but then in their retirement, because they want to continue to live and maintain their lifestyles, the orange here, that's withdrawals that they're going to have to take from their tax-deferred accounts to make their life happen. When they take money out of those tax-deferred accounts, they're going to pay ordinary income tax on every dollar that they take out. Oh, and because they're taking money out of their tax-deferred accounts, guess what? Now their Social Security also becomes taxable. So one is just kind of looking at the different components that they have coming in, but then we're going to start to add all of these up to say how much taxable income will they have in their future versus where they're at today. And then we're going to look at what tax brackets will they sit in. And just, you know how they say a picture is worth 1,000 words? Well, this picture could potentially be worth thousands of dollars because it's going to help them understand changes that they need to make, strategies that they need to implement to potentially lower their long-term taxes. So looking at the picture here, pretty easy to see. On the vertical line is taxable income. That's adding up things that they have coming in that they'll get taxed on. Right now, their salary. In the future, like I showed, withdrawals from their IRAs and 401ks, Social Security. Well, high level, you can really see here, guess what? In their future, they live into their 80s, 70s, 80s, 90s. The blue, the taxable income, is higher in their future than where it's at today. So that then leads us to, well, what do we think will happen with taxes? Do we think that taxes will stay the same? Taxes will go up? Taxes will go down? Well, if their income's higher and taxes stay the same, that means, guess what? They're going to be paying more in taxes in their future than they are today. Taxes go down, well, hey, guess what? Then they'll be lower in taxes. None of this is a concern. Or if taxes go up, then they could potentially be paying way more in taxes in the future than they are today. So you always have to ask yourself that question, because none of us know where tax rates are going to go. But based on national debt building up, based on the cost to run the government, I would assume at some point in time, my just personal opinion, taxes will have to go up in the future. So if that's the case, okay, well, then maybe Steve and Sue here have a problem. Again, this is why you have to feed in your own information based on how much you've saved up. Maybe you've saved up $500,000. Maybe you've saved up $5 million, $10 million. Well, you can understand here that the graph could look a lot different. There's a few things also to be aware of when looking at a tax projection. On this map, you can kind of see it. Right at age 75, they have this spike right there in their taxable income. It's a jump up in their taxable income. Now, if you remember, they just needed a certain amount to live their lifestyle, and they were going to also do the travels and activities from, once they retire to age 80. So why the jump up at age 75? Well, for them, it's their required minimum distributions. Those IRAs, 401ks, 403bs, you're going to have to take RMDs starting at age 75, which can cause a jump up in your taxable income at that age. So that's one of the things we got to think about. How could we potentially reduce, right, those items? Now, for Steve and Sue, some other items to consider, not for them, but maybe for you is, I just said, hey, they've got the IRA, 401k money, they've got Social Security. What if you have a pension? Guess what? A pension going to add into this some more, going to be more taxable income for you in your future. What if maybe you will inherit some money, and part of the money that you're going to inherit is an IRA or a 401k? Guess what? That's more money that you're going to be forced to take out, so more taxable income that could potentially add into your future. One other item to consider, and I'm going to show you this as we move into the tax bracket chart, is you need to consider what happens if one spouse passes away. So I put in here, what if one of them were to pass away at age 82? Well, you can see here in the tax brackets, they actually have a tax jump, right? They jump up a bracket when they go from married filing jointly to single. So hopefully you're starting to see, whether it's a couple, whether it's a single, plugging all of your information in, what it can lead to. And then it's going to start to lead to the strategies, which I promise we'll get to. We're about there, but you have to really understand the charts here and what you're trying to, what you're looking at, so you can implement the proper strategies. Like I said, it's doing the work to implement the right strategies. So now we're looking at, okay, based on that taxable income, which tax brackets will Steve and Sue sit in? Right now, they sit in the 22% tax bracket. One thing to consider, the end of 2025, the Tax Cuts and Jobs Acts expire. You can actually see that here, 1-2 years, and then right there, still working, age 64, but they jump up to the 25% bracket. And then you'll see some ups and downs here in their tax brackets, because yes, when they retire, they've got, taxable money to live off of, so their taxes go down. Maybe they start one Social Security, but they need to pull in from, their IRAs and 401ks. So that's the fluctuations here in their tax brackets, is based on when they're starting Social Securities, etc. But this is a really important chart to understand. And for those of you just listening, here's the thing. Steve and Sue, far left-hand side, 22% tax bracket. Some areas of their retirement, maybe 10%. Some areas, because the Tax Cuts and Jobs Act expires, 25%. Some areas, maybe 15%. But once they start right there, again, age 75, they start taking those required minimum distributions. Right there, it kicks them from the 15% bracket up to the 25% bracket. And then, as I showed you, as one spouse passes away, it goes from the 25 to 28. So now we know where they're at today and where they'd be potentially at in the future. Again, we don't know what Congress will do with tax rates, but you just have to make some, you have to make some good judgment calls on where you think tax rates may go in the future. Okay, so now we're going to use this information to start making decisions for year-end planning and tax strategies and things that maybe you should be implementing before the end of this year, or if you're just kind of using this video at any point in time throughout the year, kind of how should you be looking at the different accounts that you have available to you? What tax strategies should you be implementing? Like I said, 2-part series, but we really had to set things up first, show you the charts and the pictures, help you understand that you need to see where you're at from a taxable income standpoint today, and understand, and that you need to know where you're going to be at in the future so you can make more informative decisions on some of these different strategies that you may want to implement. Without the charts, without the projections, you're just guessing. You're operating in the dark, and you could potentially be causing yourself more in actual taxes. So again, two-part video, 2-part podcast. Tune into the next one because there's going to be more. In the next one, we're going to talk about Roth conversions. We're going to talk about charitable giving. We're going to talk about legacy planning. And I'm going to have other miscellaneous strategies that we're going to talk about today. But today, we're at least going to kick it off in regards to just retirement planning strategies. So if you're still working, what should you do before the end of this year to, again, help put yourself in the best position possible? So let's start with the workplace retirement plans. Maybe for you, that's a 401k, maybe it's a 403b, 457, whatever that might be. What can you do before the end of this year to help maximize, again, your tax plan, lowering the overall taxes that you're going to pay to the IRS? So are you contributing the most amount that you possibly can to those workplace plans? If you're under 50 years old, there's a certain contribution limit. If you're over the age 50 years old, well, then you can also do the catch-up limit. Now, before we even discuss putting in the maximum amounts, I think we have to go backwards a step and say, hey, are you putting into the proper workplace plan? And that's where the projection comes into play. So think about Steve and Sue and their hypothetical example. Right now, they're in the 22% tax bracket. In their future, we showed that they would, in their 70s, potentially be in the 25% bracket. If one person passed away, that remaining spouse is going to be in the 28% bracket. Why is that? Well, because for their lives, they had always saved into their 401ks and IRAs, and they're going to be forced to take out those distributions in the future. So for them, and I'm sure you saw this as we went through, they're like, wait a second, it doesn't make sense for them to put into their 401k, because basically what they're saying is they're saying, well, I don't want to pay 22% today. I want to pay 25 or 28% in my future. Doesn't make a whole lot of sense. So that's why I said we have to take a step back for a second and say, wait a second, are we putting the money into the right tax bucket? By Steve and Sue switching up which bucket they're going to put into, now they're going to start using their Roth 401k bucket. In their scenario, again, you have to understand, where will you sit today versus your future? In their scenario, by switching up which bucket, as you can see, it's going to reduce their long-term taxes. Pay tax at a lower rate today versus paying those taxes at a higher rate in their future. Okay, so optimizing which bucket do you need to put money into. Then once you know which bucket you're putting money into, are you maximizing those capabilities? So if you are somebody where your taxable income is going to be lower in your future than where it's at today, are you putting the most amount that you possibly can in your 401k today using the catch-up contribution, right? Because why pay higher taxes today when you know it's going to be lower for you in the future? So take the money as much as you can and get it out of your taxable income. Take those tax deductions today, kick that can down the road to your future. Now, for you, if you know you're going to be higher taxable income in your future, well, then why not pay what you can today, put as much as you can into the Roth 401k, so that way in the future you've got tax-free growth, tax-free withdrawals when you feel like your taxable income is going to be higher. So that was part one of maximizing your retirement plan. Let me just go into a few other things here. Maybe for you, you're maxing out your retirement plan. So where can you put money next? Well, you'd be looking at your IRA or your Roth IRA. Same scenario. Which one can you do based on where does your tax projection show you for your future? The next one here is, from a retirement planning standpoint, is the spousal IRAs. Now, I'm going to put a link to this in the show notes as well as up above. I've got a full video on spousal IRAs. But the reason I find a lot of people miss out on this one. Now, Steve and Sue are both working, but let's just say one of them was not working. Well, guess what? They could actually take and contribute to, as long as one person's working and have wage income coming in. And again, there's rules wrapped around this, but they could put into an IRA or they could put into a Roth IRA for the spouse that's not working. So they're able to, again, take some of that income that's coming in. And if they need the tax deferral, we'll shut it off into an IRA, or take some of that income that's coming in, knowing that their income and taxes will be higher in the future, get more into that Roth IRA. It all depends on your situation, but two strategies, again, back to retirement planning. You're making money, here's some things that you can do. A few others, because again, thinking about the end of the year, which also means you got to think about next year, could mean open enrollment. Are you using your flex spending account or your health savings account? Let's just say you have a high deductible health plan and a health savings account. Have you maximized what you can put into your health savings account? Because the health savings account is got like I'll call it a triple tax advantage to it. You get a tax deduction for putting money in. The money can grow tax-free, and the money can be used tax-free as long as it's being used for qualified health deductions. This is what they call an above-the-line deduction. So you're going to see the dollars that you put into your health savings account, you're going to see the tax deduction for putting those dollars in there. So no matter which tax bracket you sit in, the high or the low, it doesn't matter where your taxes are going to be in the future, putting money into a health savings account is going to help you reduce your taxable income, because most likely at some point in time, you're going to have a doctor's copay that you've got to pay towards, or medications or something. So that health savings account can really help you with that, or you just keep holding on to it and use it to pay for Medicare in your future. Let's see, what's next on my account list here for end of the year retirement savings. Let's see, the next one here I'm just going to hit on is the Backdoor Roth IRA. So let's just say that you make too much money to put directly into a Roth IRA. Yes, the Roth does have earnings limits. If you make too much, you might not be able to put money into it. So you make too much to put money in the Roth IRA, well, there is what they call is like a backdoor way to do it. Now, if you have a regular IRA, probably skip this portion because there's some caveats where that regular IRA is going to get taxed if you try to do the backdoor Roth IRA. But if you do not have a regular IRA, well, then you may want to consider the backdoor Roth IRA. It's just a way for those that make over the earnings limits, don't have a regular IRA, all their money's in their 401k, to still put money into their Roth. So get that tax-free money growing and doing that free there. That has a December 31st deadline, that whole process. Talk to your financial professional, tax professional in regards to that. I think that kind of wraps it up from we'll call it retirement planning accounts. And next week, I'm going to talk about Roth conversions. As you could see with Steve and Sue Sample, with their taxes being higher in the future than where they're at today, then they may want to start Roth conversions and may want to start those Roth conversions while they're still working. We're also going to talk about year-end tax planning strategies when it comes to charitable contributions and when it comes to legacy planning and estate taxes. So thanks for joining us on part one. Hopefully it gave you some good visuals to understand, boy, where are your taxes actually going to be in the future versus where you're at today? And starting to see that and how that then goes into the strategies that you might want to use for your future. So we'll have another great conversation coming up in 2 weeks in our next podcast episode. So if you haven't yet, subscribe to the podcast. That way you'll get notified when the next episode comes out. Or if you're watching on YouTube, subscribe to us there so you get notified on YouTube as well. You're going to find links. And again, if you're listening to this and you're wondering where you can watch it, you can always watch it on YouTube, or you can go to our website, lifemoneyshow.com, to watch it there. So thanks for joining us. And I look forward to part two, where we're going to talk about Roth conversions, charitable contributions, and legacy planning, as well as some other miscellaneous items here to help you reduce the long-term taxes that you'd pay to the IRS. Thank you.
Insurance products are offered through the insurance business Sierens Financial Management, Inc. Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.